The world's attention is on oil with the Iran-Israel situation. We go through what happened during the peak of the events, the big moves, the winners, the losers as always, and there's so much to get into in the minutiae of what's really been impacting the physical world. And as always, we cover it from many different perspectives, and more so now, the retail perspective. So I hope you enjoy. So Harry, we were what, 69, 70-ish last week, right, on Brent?
Yeah, well, yeah, we moved up. So this time last week, we were hovering around sort of 67. And then obviously Friday, you had world events going on. And then we kind of blew out to close above 70 for the first time in a while. So yeah, big volatility spike.
Above 70. Yeah, well, max, I don't actually know the high, 78, 79 on Brent, something like that.
Yeah, around 78.25 or something. Yeah.
And the whole world paying its attention to oil. So I think it's a pretty important episode that we could break things down. But generally speaking, yeah, we're here really to talk about Iran. Listen, it's not a spoiler. Yeah. But why don't we start with the summary, as always, on the temperature gauge. So starting with volatility, Martha?
Yeah, so starting with volatility, looking at August Brent futures as a proxy, getting it up on the screen now, looking at premiums versus a week ago and a month ago. We can see premiums have just shot up. There's been a huge open interest changes, but also a huge increase to the premiums of calls, especially as you can imagine, people are willing to pay more for upside protection. Interestingly, during the sell-off in April, there was lots and lots of calls being bought. So the flip side of this is, of course, there are lots of calls being sold. So when the price started to rise, the market was short a lot of calls going into the move, and because this is a more risky position to have, that was a lot of pain for traders on Friday during the gap up.
Yeah, I mean, straight away I can tell you, like, the options market makers out there have done, very badly, right? Because it's kind of their job to take on short volatility in the front and to warehouse a lot of short option positions, as generally the market for hedging wants to own them, or speculation wants to own them. So yeah, it was all of a sudden, right? There's no way. What can you do? A huge headline comes out. We were aware of Israel-Iran tensions all of last year. It was taking up airtime. All of a sudden, this can happen in all markets, right? You've got an incredibly impactful event, and on the options we had 10,000 kb, so a huge clip go through the night of the strike, the night before. So yet again, some more and more evidence of insider trading, which seems to be the normal now in Congress and the financial markets, as politics and finance get so integrated. So yeah, it was a monumental event, right? And I think we've got plenty to talk about. But yeah, volatility, of course, is the first thing. Absolutely
following
spiked.
that, it's been really illiquid in the options market yesterday and today. I touched base with our options trader yesterday, and he says it's been very dry a couple of days.
Yeah, so ultimately, if you want to own volatility up here, that's expecting even further an escalation. So it kind of makes sense that the buyers have done their buying and the sellers have kind of got wiped out. So that actually makes sense. That's quiet now, right?
Yeah, I was going to say, do you get a case where high volatility gets priced into the options, and therefore you kind of don't want to buy vol anymore because it's so expensive that you kind of need something very dramatic to happen again? So actually, like you say, people who bought vol are sitting on it, and market makers are kind of just waiting, licking their wounds kind of thing.
I guess because we're talking already quite granular. I mean, when we say volatility, there's no actual contract for volatility, right? So when you buy insurance, you buy options. Implicit in that is if it explodes, it gives you a payout. So someone's got to sell that insurance. Who's going to want to sell that in an environment like this? But actually, on the other way, I was long puts on the Trump side of things, and you went in to take profit, and there's no real bids, because it's like, well, you want me to buy a vol up here, even as a market maker? How am I going to offload it? I need to sell an option against buying it or take a view on it. And there's no way. It's the highest it can be. It's actually a real pain to get out of options as well as get in. When it really goes to town, it's actually quite a difficult market. So yeah, it's used for insurance and payouts. But I guess the best thing really, if you're going to have a huge amount of size, is to really have confidence that it's going to go to the level that you've bought protection.
You can actually expire the option.
You can actually expire the option, exactly. So if you bought 70 calls or 80 calls on the way up, it's really good protection, but try getting out of it when you've got a huge amount. So all of a sudden, like, will it actually get to 80? It's like a great insurance, but now you're looking at it, does it actually get to 80? Probably not, right? And everything's priced in. So now probably people are rushing to actually exit these things if they're long.
Yeah.
But anyway. Okay, and then the volumes and the open interest, I mean, it must have been pretty active in the last week, no?
Yeah, I mean, we'll just touch on volumes before we get to open interest and talk about options again. This on the screen is from the officials, our reporting arm. And I mean, you see all those green arrows, everything's up in the week. This is looking at contract specifics, and then non-contract specifically, the average daily traded volume across all oil and gas products globally in all tenors are up 50% week on week, and also pretty much 50% year on year as well. So we can see individually in the tenors and in the contracts, and also as a market as a whole, volumes are way up.
I think what I would add to this is, huge amount of volume increase, which is quite interesting because, with such volatility increases, to then add a lot more volume, that's a lot of risk in the market. So I imagine the open interest will show higher as well. But that shows a market that wants to get involved, which was kind of the opposite of what we've been seeing in weeks prior. Kind of people
for a while.
Yeah. So, to me, that was really obvious in the press because, in the industry, we've been talking about Iran as well on Friday, of course, and very much reacting to these things. But it was over the weekend. It was like, I was even reading in The Guardian. They didn't get a single expert quote. They said oil prices are going to rise and this is what it means. And the FT were all over it. And all these more traditional media was all over talking about oil. I couldn't believe it. Like it was very much led over the weekend that talk about oil and Israel by media, not the industry, because the industry is a bit like, look, it's had its move. On Friday we got up to like 78, back down to 75. From here, it's already got like a $10 premium kind of baked into it. Do I really think it's going to go higher? But it's almost like the media didn't want to hear that. Like, no, oil's like going to go. And you had all these Twitter things like Liquidity was like doing a couple funny memes what was it? The Jeff Bezos.
There's like the mad,
watching oil, even though I've got no exposure.
Yeah.
And it's one, trade on Onyx Markets because you would get exposure, and that's what we're here for. And there's so many nuancy things to do. But two, it just shows, right? Like the world's realized again how important oil is. Go on. What were you going to say?
I was going to say, do you think, because when this has obviously happened before, where Iran and Israel have exchanged, some missiles, but you didn't really see it back then, where the media didn't really jump on it back then. I mean. And at that time, it was still quite early, so there's no real way of knowing it if it wasn't just going to be another kind of short-lived event. But why do we think that the media jumped on it so hard this time? And like you said, I read like an article on BBC on Saturday morning, and it was like, what does this mean for like petrol? What does this mean for like this? What does this mean for like?
I think Middle East and real war, right? So I think last year a lot of rhetoric, and we've got Jorge on later to give us the geopolitical kind of spin on things, which should be interesting, but. It's when it's so blatantly like an actual, last year it was always talk about attacking the nuclear sites. And actually it was a big, if they go and attack the nuclear sites, it's World War III. And that was what was threatened. They actually went and did it. And it's like, oh shit. And we didn't get World War III, but you can forgive the media for being like, well, that's a real war.
What were we supposed to say? Yeah.
War in the Middle East.
Yeah.
That whole thing about war being bearish for oil apart from the Middle East.
Yeah.
Yeah, they're going to talk it traditional, right? So I'm not too surprised. But a couple of things. One, when we're talking about trading this event, what do you do? So if you hear the news, this is the thing about algorithms and about the news being released overnight. The market closes for a couple of hours. So, this will change, I think, over the next couple of years as we get more towards 24-hour markets and things like that. But at the moment, it closes 11 p.m. time, opens again 1 a.m. This is UK time. So it's annoying on weekends and during that time overnight because you can't do anything. And then all of a sudden, it will just gap up or gap down.
Yeah.
So that's very difficult to trade. So if you're looking at it out there and you're like, I need to get some exposure to oil, and you should be thinking about, again, this is the whole point of our retail offering, go and hedge yourself against gasoline price increases. And we'll talk a bit about how you do that later on. There is a real need to hedge yourself as a retail consumer. We can talk about that later. But when you're trying to speculate and make money out of it, it's a very difficult thing to do when everyone's trying to do it at once. And we just talked about how the options, people piled into options with a lot of inquiries from the industry, a lot of people obviously wanting to get protection from the upside, and flat price had a massive rally and time spreads. It's all a bit too late to get involved when it's already had its rally. And actually, to be honest, this second night, so the Friday trading, okay, you could have still maybe participated in the upside of the outright price a little bit, but Sunday night, you felt that retail in particular were going to really pile in on Monday.
Yep.
And that's what the industry wants, right? You're rushing in when everything's been priced in and there's all this talk. And if you'd actually been reading about what people are really saying about it in the industry, like, come on, $10 is priced in. We haven't had any indication of oil being taken offline in a meaningful way on crude. However, there were some products taken offline, right? There was a gas field hit that had a lot of LPG and condensate, so propane and more naphtha. So I think this is what you wanted to say. We were talking about it yesterday. The big message is when you're looking to profit from these moves, I mean, trading the outright price is just a gamble, right? I mean, and it's hard to do because everyone's in so quickly.
Yeah.
But if you look more at the oil swaps market or the wholesalers market, i.e. like the geographical products of which we actually use, the propanes, the gasolines, the naphthas, the shipping fuel, there's hundreds and hundreds of contracts to trade. Those were very interesting.
Yeah.
And if you noticed that, well, hang on, a gas field, the biggest in the world in Iran, has been bombed and it's got all this propane and condensate. We'll go and trade propane and condensate, which you can do by trading Asia propane, the FEI contract. You can trade naphtha, which is like more plastic generations. Those contracts are there to trade against Brent, to trade against outright, and they did perform, and you could have got liquidity on it, and it was a much more predictable trade.
Yep.
So that's my tirade on that. And I think it's really important to say that. But the second thing is, some of the industry players got seriously like destroyed on this. There was way too many shorts in the back end, probably way too early. A lot of long puts on the CSOs, which are options on the Brent spreads and WTI spreads, like record open interest on those. And it's good they had them as options because ultimately this rally has not really hurt them because it's a kind of insurance play. But nevertheless, there was a way too short of a market and they really got burnt on the upside. And I think that's why we had quite an aggressive rally as well. People really needed to stop out. But the killer for me was seeing on the front Brent spread, someone had put in a stop. And like, this is the thing for the industry and anyone who has access to the exchange, never put a limit order on the exchange. It is just something you should not do. And you might think, well, it's a stop. Of course you should have a stop. And yes, of course you should have a stop. But when you put it in the exchange, that everyone should know by now, right? Flash boys, all this high frequency stuff, that is generally well known that the algorithms are out there in the market to kind of screw you basically.
Yeah.
And what happens in this, someone would put in a buy limit order or market stop. So in other words, the person was clearly short Brent spreads, massively short Brent spreads. We think around 3,000 KB in this one clip. And they put in a stop, maybe let's say 50 cents higher, which is aggressively higher, right? 50 cents on a Brent spread is a bit overnight.
You're sort of not expecting it to actually get triggered.
Get triggered, and that's why you've got it there because you're thinking, well, if it gets there, something's happening. I better stop out. But the worst thing you can do is do it overnight, especially because once this order is triggered, that market order, the way it goes is you've said when it gets to this level, stop out. But when it gets to that level, that just means that it's the market value is there. So there's a bid at that level or there's a trade at that level. And so the exchange goes, right, trigger it. But it triggers a market order, which means satisfy the entire volume at the price that you can get that volume off. Right. So what happens is you put that order through the exchange or the stop. You've put the stop on the exchange. The stop is then triggered. That then goes to the matching engine and goes, right, get me orders to satisfy this. The high frequency traders go, cheers, son. Yeah. And go, right, you're so slow. I can see this is how like tiny the millisecond difference is. It's called latency arbitrage, right? So the order comes in the time that the high frequency traders have seen it come into the matching engine. They can front run your order, buy everything up, and then like offer you the volume at a level that they want to, which you have to satisfy. So it's the most obvious and easy trade for these guys overnight because there's no liquidity. So you got 3,000 KB saying buy at market. And let's say it was like 120. I think it was like $1.20. The stop is triggered. From what the evidence I can see, the high frequency traders swept up to $4. $4 is like an all-time high on Brent spreads.
Yeah, this is right? per barrel.
It's per barrel, and it's a time spread, like a big move of 50 cents, like we said. Yeah. So an extra almost $3 just swept up all the volume that was there because to get 3,000 KB ahead of this guy is quite easy overnight. Yeah. And then this guy, it's a market order. He can't do anything. It's an automated thing. So I don't know if I'm explaining it completely well, but the point is that it is the worst thing you can do. Like ultimately, it's actually better to just the market come in the next day and the market's higher and you just go and execute it market or wake up in the middle of the night. Like just doing that guy lost $10 million.
An extra $10 million.
And he was probably trying to protect himself 500 grand.
Yeah.
So there you go. Like, that's just one of those things. That's the big lesson in these situations in particular. But the other thing is just don't put stops on. Like, we used to have all these conversations about it. People leaving stops at brokers overnight. And you're like, what do you think the broker's going to do? Yeah, the broker's going to go to one of his clients. Oh, you know, if
I've got a stop order.
Yeah, I've got a stop order. I had it. There's an iron ore trader we had. Do you remember? The guy, it was like 6-7 years ago. And he kept getting stopped out overnight. And we're like, oh, really? That's so weird. And you give it to a broker and he's like, oh, it tells all his boys, yeah, basically the stop order's here. So if it gets there, can you
stop me out?
You can just stop me out. Yeah, sure. By the way, I'm a buyer all the way up to your stop just by coincidence.
Yeah.
And, this is the thing. Like, you got to be very, very, very careful.
Yeah.
So anyway, that two things there. Much better way to express your trades, and there's a lot of opportunity in events like this, but not necessarily in the outright price. And two, be careful how you execute it, right?
Yeah.
I mean, go to some guys like the Onyx Markets guys who are professionals and there to protect you. That's the whole point.
Yeah.
But yeah, let's just finish with the open interest.
Yeah, so the open interest, just very quickly, I think this is the best graph to represent it. So this graph shows well, I think, what's happened in the past couple of days in terms of volatility in the options. So we can see the different prices for the different calls and puts here labels at the top.
So what are we seeing here? So 65 puts is the red line.
Yeah, that kind of crashed yesterday.
75 or 60, where are the calls? Sorry.
The calls are the blue line
yellow.
and the yellow line.
Right, okay.
So there was an increase in the 75 call before it drops heavily. And then interestingly, we have seen the $80 call be more expensive than the $60 put for probably about over a month now. But we've seen this reverse and the put has become more expensive. So therefore people are willing to pay more for downside protection at 60.
Yeah, which shows you basically the market feels, I think the combination, those prices are all like evened out. The market's kind of fairly priced here in terms of in this event, what people are expecting. Probably producers coming into hedge on the up to sell.
I was going to say, do you think a lot of that is sort of like you sort of create the demand as you go higher for the producer puts?
Yeah, and they've been moaning this whole time about, you know, all the articles and the shale oil being over at 60. And even as it was getting more towards 65, 67 on WTI, there's always articles coming out being like, it's the end of shale oil. Okay, well, now it's not the end of shale oil. Why don't you hedge? Like that I think is the overwhelming message. So if you were I think the problem with shale now is that there's a lot less independents. They've been swallowed up by the Chevrons and Exxons who don't like to hedge. So actually, I wouldn't really necessarily expect a swath of producer hedging, but we did used to get that in an environment over WTI over 70. You just get like selling because I think it's very economical. It's like the perfect level for them, really, in a sweet spot. All right, let's talk about the herd mentality. Okay, so for this one, of course, we're talking about the Iran-Israel situation. I think we need to start again a bit like what happened, what's going on. We've got our geopolitical expert, Jorge Montepeque, who runs the officials. You've seen every week. That's the guys, Ed and Will, are talking about the nuances in the physical market. It's ran by Jorge. So Jorge's out in Dubai in the Middle East. Very good place to be right now for insight into this situation. So hi, Jorge.
Hello, how are you guys doing? Well, we're very close to the Strait of Hormuz. If you call that good, I'm not too sure. But
for the purposes of this analysis, journalist on the ground.
So the straits are almost equidistant from Dubai as Abu Dhabi is. Maybe a little bit longer, but yeah, we're very nearby, but we haven't seen any missiles flying over, so we're pretty happy.
So Jorge, can you give us, I guess we need a summary because this is a week ago since we've done the previous podcast. We needed a bit of context where we are now with things. This is Tuesday morning. This will probably go out Tuesday afternoon. So I'm assuming a lot's going to change. But can you just give us a summary of where we're at from a geopolitical standpoint relative to, in the context of oil markets?
Well, I think the higher level issue is the lack of trust. If you go over the issues between the three parties, Israel, the US, and Iran, a lot of the negotiators from Iran have been steadily being killed over time. And Iran got bombed right before the discussion with the US. So if you put yourself in the situation of Iran, should you trust anybody and anything? And I personally would say, I better hide in a cave somewhere rather than talk to these guys, because I don't know what's going on. And the US administration says on one side, we're not involved in any of these military matters. And on the other hand, the US says, Trump says, we're helping Israel pretty bigly. So who do you want to believe, the official narrative or the other official narrative? And I think you very much are going to conclude that the US is involved in what happened by the Israelis bombing Iran. This situation is rather serious, and it has led to a lot of money flowing into the oil market. And that's why we have seen all these jumps, because everybody is foreseeing a huge issue in the Strait of Hormuz and in the movement of ships in the area. As an example, this morning there were some accidents which are very frequent in the shipping market, but everybody got very excited early on and talking about GPS jamming, and there's some big superpower that dominates hundreds of square miles and can disrupt shipping and things like that. So the market is on a bull mode, listening and reacting to any minor thing that reconfirms the bias they have. But the situation is very serious. At the end of the day, it's a lot of talk and a lot of action to force Iran to submit. Quite clearly, they're not submitting, or not yet, and there is a lot of engagement from one side to the other. So what are the next steps? And we always need to look at the next steps. Number one, the US is moving a lot of air tankers to essentially fuel planes in the air, presumably to do more effective bombing over time. That's a really serious bad thing. On the other, there was a rush meeting in Calgary with the G7. And one of those members of the G7, Japan, is heavily exposed to anything that happens in this area. This area is very critical, and close to 18 or 20 million barrels a day may flow out of the region. And one of the most exposed countries is Japan, because they need the oil and the LNG that comes out of Qatar. And I think some other countries, including over here, would need some of that gas to keep the lights on. So the pressure is on at a political level not to do anything rash and bad that would threaten the flow, because that would essentially lead to major economic issues in Asia. So I am one of the, I guess, in the minority with the view that this pressure by so many countries on the US to behave itself and not to be the source of global instability must be weighing very heavily on Trump's head. Trump, on the other hand, is, I think, led a little bit by ego, and he doesn't want to lose. But he is now finding out what real serious politics are. You have countries that, like Japan, that are heavily exposed. Europe is also exposed. You have China, which definitely gets a lot of its oil from Iran and Russia, and I don't think they're going to stand idle if something serious happens. And you have the promises that Trump made to his voters, that he wouldn't bring any more American soldiers into wars. And maybe you saw this morning that already there are some fights intra-MAGA, where Carlson already coming against fighting the Israeli wars. And Trump is tweeting about it, getting against his own MAGA base. So as we go forward here, I think we need to consider that if there is no real impact on the Straits of Hormuz, we may see a huge sell-off. And that is because in some other analysis we were doing, we see that the front spreads are being bought quite a lot. And that would mean that there is a shortage of oil when the backwardation increases. And we don't see anything like that. So the only credible explanation we could come with is that dumb money is going in. And that means either retail being attracted to buying a lot of oil and they would buy the front months, or traders that want to throw a little bit extra money into that front spread. But the front spread is not being warranted by what is going on in the fields right now. But back to you, Greg.
Great. Thank you, Jorge. Thank you. So I guess, do we have anything to add in terms of the contracts out there? I think is probably the best thing. So you've said Brent time spreads, WTI time spreads have rallied like a considerable amount, and the outright price, Jorge says. So these are the things that you'd expect to come in as de-escalation happens. The only thing I would say is that crude has been having a run up structurally, right? And I think Jorge actually even himself have been quite bullish, quite constructive before this crisis. The utilization rates from refineries in the US have gone skyrocketed. There's a lot of strong demand in the very spot market. It's the only thing I would counter, what Jorge is saying. I think there is, wouldn't call it dumb money entering on the time spreads right now. I think it's trying to push it, like he said, like the latter option, like people really trying to push it now for the last kind of couple of months as we're in summer. But maybe the deferred contracts, that was a lot of stopping out. A lot of people short kind of Cal 26 spreads, time spreads, and short longer term flat price. Yeah, that probably has just been volatile given the excess positioning on the short side. But it's a good time to enter if you are bearish, because it's just the market's just given you a really nice re-entry price, right? I mean, anything else to say? I mean, maybe the other nuancy contracts, what stands out really?
Yeah, I mean, I was going to say is if now's a good time to talk about sort of how the like freight has moved and how that's moved, some of the differentials. Just if we're talking about sort of what's moved, we obviously have freight moving higher because of higher insurance. You have sort of like geopolitical premium on freight and associated differential contracts, which are very prominent in our market. We can trade them on Onyx Markets.
Basically prices between different regions, right? And they have to factor in shipping costs to get it to the two regions. And it's been volatile, but not that volatile, right? I mean, I think even with the Red Sea attacks from the Houthis last year, we had probably more volatility in freight contracts.
True.
Freight prices, and therefore these contracts. So what comes to mind really is actually more of the things like Deck June Deck Brent fly, or WTI fly. That is something where you're selling more near dated spreads against buying later dated spreads, but this is in next year. It sounds complicated, but selling Deck June Deck 25 into June 26 versus buying June Deck. And that gives you a very nice relative value trade, because that is just completely blown out. I think it got to like $1.10 when it had been down in the 2030s, maybe even lower. So you've now got basically the market has had to really buy back spreads to cover its massively short position. But when you're looking at that fly, as they call it, that Deck June Deck, that is structurally telling you quite a lot. Like for that to be $1.10, the market's going to have to be very constructive next year. It's going to have to be a very tight market, and all the indications that that's not the case. So I would say that's probably one of the most standout trades right now that I can think of. And then I guess what surprised me a little bit is the naphtha and propane market, or naphtha market in particular, hasn't overwhelmingly reacted. And I still think that could be quite bullish because it's a short market, and Iran's condensate is quite a big pool, right? It's quite a big pool of the exports in the East. So that's still a good trade. I wouldn't fade that price actually. If anything, I would keep buying.
Yeah, it's sort of trade it as like a sort of lagged response.
Exactly.
It's in this. The price hasn't caught up with the potential fundamentals yet.
Which is why I love this market, right? And everyone's focusing on the outright price. But there's all these real things going on that actually you got more than enough time to react to. It's a general point.
And then the trades, like you said, you're looking for. Me and Tom were talking yesterday about sort of trade ideas, and you want to think about what's the good thing to fade, because it's always the case where things will get overdone. Like you say, you get a lot of external money piling in, potentially at sort of when it's too late. And then they're sitting on risk at a high level, which is going to need to be stopped out.
Well, I guess, one I didn't mention is the gas oil market, or the distillate market. That crack rallied in line with Brent, $3-4. And that was already a vulnerable part of the curve that we felt that the distillate market, with refinery margins so strong and refiners are really ramping up, they're going to be producing a lot of distillate when there doesn't seem to be a huge amount of demand. And yet it's just rallied another $4 versus Brent. So it's outpaced Brent.
Gas oil has outperformed Brent,
that seems like a sell.
Yeah.
If you're talking about a fade trade as well. I guess we're getting ahead of ourselves for some reason. But anyway, is there anything else on this, Martha, on the herd mentality? Maybe just any more information?
So looking at the oil and gas things that have been struck by predominantly by Israel in Iran, and we've seen explosions and fires, starting with the South Pars gas field. They have cut around 12 million cubic meters of gas output, which is about 60% of their overall output, which is a huge amount. There's fires still raging.
Sorry, this is in what?
In the South Pars gas field. This is in Iran, shared with Qatar.
But is in what output of gas or LPG
Gas.
or everything?
LPG. So gas condensate, so specifically 77,000 barrels per day of gas condensate, 2.9 thousand tons per day of LPG, some ethane and sulfur. A lot.
That's quite a lot of the lighter end market. So, okay, we're not really talking that much about natural gas. There's a lot going on with natural gas in the world, but they are quite localized markets compared to oil. Oil tends to be very well integrated. So yeah, we've got to focus on the propane and naphtha as being, the propane did react, I think, and propane actually outperformed naphtha. But again, this is my point. Like, there's real structural oil being taken offline there that needs to be replaced, and can't immediately be replaced because it needs to be refined, or the splitters and things like that. So that would be the most interesting one right now to kind of.
Yeah, I wonder if the gas oil rally, because condensate, when you split it, you get some gas oil molecules as well, right? As in, some of the splitters produce like kerosene and some gas oil. Depending
on what crude or input you use, right? Yeah, for sure.
Yeah.
But yeah, I guess in a way as well, if there's a really strong performance in naphtha and propane, usually these markets are really lagging the kind of global market, and it's been an issue structurally for a while. Like WTI Midland, for example, there's a big shale oil production boom. Is that oil, which is naphtha yielding, right, and propane yielding. So it should actually help light sweets. And then we're back to this discussion about Brent versus Dubai. Brent versus Dubai has had a bit of a weird reaction. Again, everything Jorge was saying, like the threats of the Straits of Hormuz closing, this kind of things, you would say, well, the Dubai benchmark is vulnerable. If things were to really kick off and Dubai was to get very tight, all the oil taken offline, then you would have Brent versus Dubai really contracting, i.e. Dubai getting very strong relative to Brent. And that's a very localized pricing thing. But the market, actually, if anything, Brent Dubai went a bit higher, because there's another way of looking at it, which is saying, well, freight prices could get higher, which means you need to have you get more of a supported differential. But it's just so much nuance. And we've got the official guys, I think, to talk about that in a bit more detail, which I think is worth doing. So crossing to the officials now. Just you today, is it, Will?
Yes, just me today. So we'll talk a bit about kind of the market reaction in the Dubai market in particular, and the Brent Dubai to the kind of kinetic escalation over the weekend. The market was, and a lot of analysts were particularly fearful about closures in the Strait of Hormuz. But the Dubai benchmark has been specifically designed to kind of diversify risk. A lot of oil does still transit the Strait, but in response to the tanker wars in kind of the 80s, for example, Aramco have built the 6 million barrel per day East-West pipeline. The UAE also have the Murban pipeline that dumps out of Fujairah, and Iran as well have their own pipeline that exports to the Gulf of Oman. So, realistically, the likelihood of any sort of serious impact to transit through the Strait was going to be minimal, even if Iran decided to attempt to. But of course, as I'm sure Jorge elaborated on, it would not be in their interest. So I think a lot of the reaction to the news was almost kind of the realization that the Strait, there was not going to be necessarily any risk to the Strait of Hormuz. In the case, let's say there was, you would have a slightly reduced Dubai basket, but you'd still be able to declare Omans and Murbans, which have been the majority of convergences last month. But nevertheless, Dubai should rise relative to Brent. as well as the geopolitical risk element. But we didn't see that. We saw Brent Dubai kind of almost blow out a little bit, as we can see on the chart. And it gapped up on kind of the open on Monday, on Sunday night, Monday morning. The Balmo Brent Dubai then sold off throughout the morning, and our sort of Brent futures against August Dubai partials fell 10 cents on the day as of the close of Asia. But as you can see in the chart, it quickly retraced that move, and Brent Dubai has been trading higher than pre the intervention. We have seen a strengthening in physical premiums in the Dubai spot market. So the phys premium rallied on pretty thin liquidity. Actually, there was only 5 partials traded yesterday, and that rallied up to $2.07, which is the highest since April. But yeah, the move higher in Brent Dubai to me suggests the market kind of realizing that the oil will not stop. There's very little that Iran could do to actually fully force majeure the Strait of Hormuz. It would be diplomatically suicide as well as economic suicide for Iran to actually shut it off. Although it is in their interest to give the kind of the idea that they might shut it off, as in that elevates oil prices, but shutting it off entirely wouldn't make sense. Thinking about other similar situations, oil still loads from Fujairah. It did throughout the Houthis' intervention in the Red Sea too, and oil still transited the Strait of Hormuz during the tanker wars in the 80s. So yeah, I think that's kind of the realization that the market has come to.
Yeah. So in summary, no oil impacted, but the threat still looming. That's the leverage of the Iranians. So there's volatility around it. But what it definitely does mean is that Brent price crudes, the alternative grades, if you can source them, are going to be more attractive at this very minute, right? So, whether it's the insurance prices going up or if it's just like, I just don't want the hassle, you're going to buy more Brent price crudes than you would have done. So if you would buy Dubai price crudes in the region, but you can actually buy West African, it's not that far of a difference. You're going to buy West African, right? If it's not going to make a huge difference to you. And I think that's why really this market is probably the most bullish as it stands for the dated Brent market, the North Sea market, because there's every reason in the world. Remember, the physical traders are marketers. They aren't just passing barrels immediately, buy it immediately into refiners. They have to buy in the future. And they have to take a view on it on themselves, and they have to look at refinery economics and see where the demand is in what region and kind of preempt it, and then go and convince refiners to buy it at the level that they're satisfied with. And I think it's quite a easy pitch right now to say to refiners, if you've got a dated Brent price crude in whatever region, the Mediterranean, the North Sea, the West Africa, saying, guys, come on, it's a lot of risk to take to Dubai. I think it's worth buying this. The yields of this, this is what's going on. Propane and naphtha should be performing. Buy my WTI Midland, whatever. I think that's quite likely going on. I think you're seeing it in the pricing, aren't you, Will? The dated Brent spot market has performed. But yesterday, that was the one that did perform compared with Dubai, right?
Yeah. I mean, physical differentials rallied pretty strongly yesterday. They were up like 30 cents on the day. So, it was a very big win from Mercury and Totsa after a lot of Midland, Ecofis, cross grades actually, Brent as well. So yeah, it was a very performing market yesterday.
So I guess, again, just to close that off, because we were talking about the Brent versus Dubai differential, that's another reason for the Brent versus Dubai to be supported, right? It's just alternative Brent price grades more in demand right now because it's just safer. So naturally you get a bit of support for Brent Dubai. It's a bit all over the place, but that's what happens in these kind of events. But thank you, Will, for that. Okay, so let's move to what's going on with the players. Let's start with the hedge fund watch.
Yeah, so the headline on the screen, we actually have an oil-specific one this week, is that Citadel is hiring a veteran US trader, Barnier, to bolster their fuel trade, kind of get a foot in the door with the US fuel.
Okay, that's quite like niche oil. Yeah, fair enough. Again, I don't think hedge funds have done particularly well this year in oil. Elsewhere, they've probably done okay. So yeah, that's just expansion. That kind of makes sense. Not too much to derive from that. But what about hedge fund positioning and how have they been positioning?
This is our Onyx proprietary CTA positioning model. You can see that all of the respective contracts, Brent gas oil, heating oil, RBOB, and TI have all moved up into positives, slight positives from here. So this means more that there is a more equal upside and downside risk from CTA moves. There is now better room for them to sell if they choose to do that. But also there is still room to be, buying a lot.
This is significant because we've always been saying this year the CTAs have been way on the short side, and if they ever were to scramble to buy back, on the basis of the signals that they do, there's a lot of volume to be shifted. But the volume has been shifted, and you've got to say that we did say would cause a price spike probably above 70. But for it to only be like 73, 74 on Brent with all that volume shifting also, that's quite interesting because there must be quite a lot to absorb on the sell side.
Yeah, and where would that come from? Because like you say, you sort of think if you sort of marry that with the, obvious macro events, you get like a sort of so much money flowing in as well. You have that too. Well,
what you'll see on the CFTC report, I mean, it obviously has to even out, right? There has to be a seller to a buyer. It's going to be in the producer merchant section, like for sure. I guess it'll be more interesting to see, or the swap deal, i.e. the bank section. The bank's been doing a lot of selling because that would be producer hedging.
Lots of other reportables, lots of selling from them.
So a lot of prop firms. Oh, that's interesting. Okay. Yeah, that is interesting. But either way, I think it would speak to an opportunity for producers. So if it wasn't them, I mean, it's giving an indication you probably should be selling. You want that liquidity at a higher price. Yeah. And you're concerned about longer term weak prices like the whole market seems to be. This is a great opportunity to be selling. But that's interesting from the hedge fund. So that's CTAs. And then discretionary money, I mean, I guess it's been in line.
Yeah, we've seen net positioning increase. We're net positioning rising by about 17%. Long positions up 6%, short positions down 6%.
Yeah, okay. So as you'd expect, quite a lot of hedge funds piling in. That's Brent. WTI, I mean, it must be similar, right?
Similar.
Yeah. Okay. I mean, it's just not too much to say. I mean, if you are a hedge fund and you haven't been pre-positioned, you're like any other player. You're like retail. You're like anyone trying to look from the outside, not have the physical. So you're just trying to get involved. And what do you get involved in? Again, it's hard to do when everyone's already done it. If anything, you're looking to fade the moves, probably where the money might be. So that's probably where hedge funds are as well. But is that kind of a summary? That's a summary. Okay, yeah. Not too much going on, I guess, with them. All right. Let's move now to the crack spread Chronicles. Okay, so this is where we're looking at the refinery economics and the changes. Again, it's been a really interesting area for us to focus on. We've been talking a lot about how refinery margins are so strong in the prompt, and it's a really important thing because to be bearish the market long term when the refiners are making so much money is a dichotomy in arguments. Yeah. So refined margins went even higher, right? I mean, that's.
So I've got them up on my screen now if we want to put those on.
It's great news for refiners because it was on that decline. But I guess Sunday night, what happened as well was we had, as well as this situation in Iran, Israel, we had the Texas City refinery go down, which is 670,000 barrels a day, pretty huge refinery in the US. Yep. Whilst the US are ramping up hugely their utilization and producing a lot of products. So for that to suddenly go offline, it's incredibly bullish, the gasoline market and probably with it, the distillate market. So it's logical that there was some buying. I mean, it's not overwhelming buying though, to be fair. So it's got its kind of short-term relief when the fuel oil markets have rallied again. Yeah. We were kind of thinking it was on its way down. Yeah. But it's had another rally once again. Again, the link with Iran is an easy excuse, right? And Iran's the gyro.
I think our fuel trader here was just saying, the way the market's trading is it just does not want to be short. And, any kind of news, it finds sort of the bullish angle on it. And, like I sat down on yesterday morning and was like, oh man, fuel cracks must have gotten like smoked on this flat price move. And you just look up and it's like $1.50 higher. You're like, same with gas oil. You're like, man, these products are outperforming something that is getting driven super high.
Yeah.
By
so interesting
money. So, and I know that the traders are saying, just people just don't want to be short because it's just, it seems like it's kind of like sustained, like insane high levels. And then you just take any kind of external event that's just being like, well, I guess it's, you've
got to buy refinery equity. I think that's the only really story, to be so stubbornly bullish on the refinery margins and to get even more of a boost. And I guess if there's any hedging coming, we did see refinery hedging actually. We did see some yesterday, particularly in the east. So quite a lot of volume go through, which makes sense. So if they've locked it all in as well, the refinery is going to have a great 2025. I think it's going to come out in their results, their quarterly earnings. I mean, that's all you can really say. I still don't really understand the fuel side. Let's see. We still expect an unravel. In a way, it's in line with our view a lot earlier on, which is, the summer peak does come. The summer demand will be there. If you take the Iran-Israel situation out there, because refinery margins have been so strong, it is logical that the spot crude market has been very strong. So there's nothing like completely insane about this move. But I do think, that has to be a loser somewhere. And unfortunately, it's big time going to be the end users in the last kind of few weeks and probably going forward the next couple of weeks, right? They're going to be paying prices they shouldn't really have to pay based on just fear and no real huge impact other than this refinery in the US. Anything else to add on that, on the crack spread Chronicles?
No, just to add some stats to what you were saying about the refineries. In the US, refinery utilization is up to 94.3%, and we've seen the highest crude intake since December 2019. So they're running.
As in on a week-on-week basis or outright?
EIA stats, the highest.
Just overall intake. Oh, wow. That's surprising to hear. Okay, well, there you go.
So they just all out. Going all out.
I mean, that's you can't really get more bullish crude. And again, if you've got the marketers of crude oil saying, buy alternatives to the Middle East right now, then you're also got a great export market in the US. So the US are pumping like mad, making lots of money as refiners and probably making a lot of money on the crude side. So it's a good time to be a US company in oil, basically. All right. And now we do the kind of extension of this section, the retail, what do you call it? Pump perspective. So the wholesale prices, I guess we've got to talk about that. Obviously, we talked last week about there being in the forward curves, and we can see, obviously, if you're trading this market, you can see that prices are getting higher. This was before this crisis. And so, it's lagged, right? So 1 month, it prices out and the wholesale market does what it does, sets the price for the month. And then that then feeds to the retail market, and the retail market has to buy at these prices. So we know if there's going to be price increases or decreases. And we've got an index coming out soon to kind of reflect that for everyone and hopefully trade ahead of it as well. Now, that was going to increase by 10% anyway. Now you would think probably even more. But the good news in a way is while people are, saying, God, this is going to be so crazy for oil prices. Well, remember, it's on an average basis, like 1 or 2 day spike. It's not going to, you have to look at the average of the month really when people are selling the wholesale gasoline, let's say, or distillates into the retail distribution market. It's not 1 or 2 day spike. It's not like that. It's a huge amount of oil each month delivered at one price for the month or over a time period of a few weeks. So you don't just go, oh, price is up, you're screwed. It's it's got to average out. So if we do get a fade now, like let's say this week there's a big announcement, Trump keeps saying that there's going to be an announcement of a ceasefire, hopefully he's right and does pull it off, then the prices go all the way back down. And actually you'll get on an average basis of 30 days, not a huge amount of impact. So fingers crossed that's what's happened.
So just to add to that, so on Friday, and yesterday, we saw wholesale prices. So this would be the price that the fuel suppliers who are procuring fuel to sell to the retail stations will be hedging at, or agreeing to buy kind of fixed forward prices at. And we saw like £50 per ton increases in diesel prices, so around £35 per ton increases in wholesale gasoline prices. So that's amount equates to what, around kind of 4p per litre for diesel and around 3p per litre for gasoline. But
that's if it stays here.
It doesn't mean that it's going to, immediately get these increases at the pump, even though we know that there is a certain asymmetry where pump stations, especially those run by the kind of oil majors who rely on this kind of like brand power, and not like the supermarkets who, just want to drive footfall, they'll be very quick to raise prices, regardless of how quickly it takes them to turn their tanks over, i.e. when they're kind of buying in new fuel at a new price. Whereas the supermarkets, well, they will want to lag as much as possible to drive footfall, but prices that these guys are actually hedging at, those wholesale prices are higher. So if they want to come to the market to hedge now, then they are going to have to pay these inflated wholesale prices, regardless of when they're actually kind of, the pump stations are actually kind of refilling the tanks and then passing that cost on the consumer. So like you say, you won't necessarily see it straight away, but if we get these elevated prices, this week, and these pump stations start to like turn their tanks, buy new product at a kind of new kind of spot price, then you might see them starting to pass these price increases on to consumers. And you'll see it at the kind of Shell BP garages a lot quicker than you'll see it at the supermarkets. Because they're any opportunity they have to raise their prices, and then
the competitors are, if they all do it at once, then
you have that kind of cartel pricing.
Yeah. I think it was interesting when we talked about it last week. We cut up a clip and put it on TikTok and YouTube, but TikTok in particular went wild with the comments, a lot more comments than we usually get, 100 odd comments. And there's just a lot of clearly people pissed off at this, why are we getting increases? It's always the classic way, much more increase on the way up, like you say, and slow decrease on the way down. And in general, it's just, fatigue at like yet more inflation when it's just some random fucking event in the Middle East. It's got nothing to do with people here, but this is the problem with the oil market, or sometimes it can be a good thing, how it's so integrated. So I guess, seeing the frustrations, that's why we have launched a retail offering. And I guess talk a bit about what we're trying to do then, the next stage, particularly for the UK, right? We've got the index coming out.
Yeah, so we're currently building a kind of UK, multiple UK indexes for gasoline and diesel, where people will be able to sort of see a breakdown and a price for, our kind of theoretical wholesale pump price. We'll have a price which will reflect the kind of at the pump price. We'll have a price that will reflect kind of like rack price, which is a bit more a wholesale price. And generally the pure kind of wholesale underlying price on a kind of pence per litre basis, as well as dollars per tonne.
Yeah, so why is this good? Because you'll be able to see it going forward. So when we say, we know prices are going to increase, it's not because we're magicians, can see the future. It's because that is the way it works. You trade ahead of time and it's lagged before the retail or distributors see it, or get delivered it. So you will see with this index, essentially, June, July, August, September, October, you will see like just going forward in quite a lot of detail what prices are going to do if they stay where they are right now, if they're going to go up or down in the future. So that's one thing. So when you say, the Iran-Israel scenario is going to screw me at the pump, well, you'll actually see by how much, which might not be hugely useful when you're losing a lot of money. But at the same time, you'll see it's not an incredible impact right now on an average of the month basis. Like you're not going to see £2, but it's not going to be like it was in 2022, not even close, as it stands with the current situation. And if anything, it might normalize. But getting that kind of visibility on price is something that we think is really important. That's stage one. Stage two is like, well, what can you actually do about it? And this is the thing: if you're at home and you're frustrated, the oil markets are this thing that's going on that you just have to accept. Well, that's the whole point. No, you don't. You can actually access this exact contract that we're designing, which kind of does relate to the wholesale market, but we bring it back to how it impacts you, the price that actually impacts you. And you can trade that price, right? And that's really important. But what does trading mean? It means don't go out and speculate and gamble on it unless you really want to. This is about saying, well, if you can get visibility on what your price is going to be today, next month, the month after, let's say you got a big journey, or you're forced to pay every month, £200-300. Well, that £300, you can essentially insure yourself by buying one of these contracts, and gasoline in particular. Buy in summer, buy whenever you think there's going to be an increase in your spending, or just your general spending. And if something kicks off in the Middle East, you'll get protection, right? The price will go up on your hedge, and you will get some money, and obviously you'll still end up spending more at the pump. But at least you've got something to slightly offset.
Insurance,
Now I know people are going to say, you have to be a trader, you have to manage that. It's a lot to manage. So we're aware of that. So we're working very hard to be transparent, to come up with a product that actually does help the end user. It's not like, is intuitive to understand as an end user. It's not just like become a trader overnight. So I think the best way to kind of do these steps is to offer an options contract, right? Which is essentially, you buy once, you buy basically a small premium like you would any insurance. And what happens is you will lose that money if nothing happens. But it's obviously going to be a smaller amount on what you usually pay. So it's £300 for your filling up your tank. It might be, £25-50 you pay. But if it does, prices do spike, you will get protection on, maybe £100-200 return if something nuts goes on in the Middle East. And if you feel like you want to protect yourself and your savings, that's a very smart thing to do. Obviously, we want to do this the right way and make sure it does really work and it's intuitive and it's not just gambling. But that's an example of what we're trying to do. So
and effectively, we're giving everyone the same access to what right from the very big companies, the way they are hedging this as well. These guys who are buying this fuel to sell to the retailer, we are giving the retail people access to the same kind of contracts that the big guys are using.
Well, and crucially, the bid offer, right?
And
it's another thing we say, if they're not in the market, they're going to get ripped off. So no, that's the whole point. We're going to give you the same price we give to BP to the end users. This is a big part of what we do. We're really passionate about it. But let's not talk too much about it. Let's just deliver it. That's the way we do it.
Tell you that we've done it rather than do it.
But it was just very interesting to see all the comments. Like I know it's a pain point, but I didn't realize. We didn't even say that much. We said a 10% increase. People are like, for fuck's sake. And it's like, you're right. You should be able to be at least able to do something about it. And that's what this journey is all about.
Yeah, exactly. Having the option there. And if at least for us to just try and shed some light on the kind of, the actual like pricing mechanisms and strategies.
Transparency will help.
That the petrol stations employ. So
it's quite, just to finish that, it's people say, what's the big deal with transparency? But if people can see the price, people get visibility, they can comment more, they can put pressure on their local governments, their councils. They, why is the price so different in Birmingham versus, wherever, Manchester? Because there are these price discrepancies. You can hold people to account, which is a big deal. The distributors can hold the wholesalers account, who, are doing a lot of, making margin in between. And that's one thing. But I think then if you can actually act on it, it will lead ultimately to more efficient markets, which should mean lower prices, because there's a lot of margin being taken out in the world by oil traders, right? You've got a $200 billion a year. In 2022, there was an estimated $200 billion of EBITDA, of company profits made basically in the margins from buying the oil and supplying it, which is a lot of inefficiency.
Being a middleman.
A middleman. So if you can distribute that into the world through more efficient trade, it's going to be lower prices. So that's a huge, huge deal. It's something that we're all about. But again, the very beginning of this conversation, right? This is the next 5, 10, 30-year plan. So,
for sure. And getting companies more educated on hedging, because, a lot of the reasons why these costs get passed on to consumers is because the companies who should be hedging and managing price risk better don't because they just say, well, we've never done that before, and basically the consumer just takes the cost, so why does it matter?
Exactly. Okay, great. Right, let's now move to the winners and the losers in the market lately. So let's start with the gold rush. Okay, Martha.
Yeah, so as you mentioned before, there's been loads of buying in the spreads. On my screen is the WTI spread, which saw even greater support, well, apart from that crazy move.
This is the front month.
This is the front month WTI future spread. So you can see that gap up and the price is sustained over 160. And we've seen the TI Brent increase as well, which shows that the strength in the WTI spreads exceeds that of the Brent future spreads.
Yeah, and again, with time spreads, it can overcook, right? It can, like, particularly in WTI, people trade a lot of WTI to speculate in the US, and it drags up the time spread. So people buy the outright contract in the front month, and that drags up the time spreads with it. But the time spreads, remember, are genuine physical, like there's physical economics in that time spread. Difference between 1 month and the next is essentially storage economics. If there's none available and there's a real need for the oil in the prompt, the time spread has to go higher. So it becomes indication of the physical differential, like the premium of the market And so 160 is an incredibly high price. But remember, you do have a lot of bullish reasons in the market without Iran-Israel. So it's not illogical for it to be high, but it just got a real nice boost from this. And it probably has
trade house buying.
Lots of trade house buying, not surprising. So what will happen now? Well, ultimately there's an element of it being priced in. There's a great liquidity in the WTI time spreads. There probably will be a bit more profit taking. But the thing that is a little bit dangerous for longs, it's less of a problem now than it used to be before US started exporting. But the big trades that historically, if you go on Google and type WTI Cushing, shitload of money to be made shorting, just look that up. It was a quote from a court case, basically, where I think it was the SEC or the regulators were trying to look into people at Cushing who had storage, who owned storage in the storage area. They're basically saying what happens is if the time spread gets too high, you basically sell an incredible amount of the time spread, selling the front month and buying the next month. And because you own so much of the storage, the only way you can buy the oil on expiry is if you have storage or somewhere to put the oil. Because what you're going to do is in the middle of Oklahoma, you can buy it and put it on trucks and pipelines and do your best. But what happens in a glut, or when the oil gets really thrown at you very quickly, there's not enough pipeline capacity. There's not enough trucks. I mean, I've seen videos, and again, you can check this out on Google, like trucks coming out of Cushing. This car driving the other way to trucks piled up, and you just like as far as the eye can see, these trucks all lined up. So it really does. You can force a glut on the market very quickly. So traditionally, the trade houses and the majors who have huge derivative books and huge physical books, they they use this opportunity with time spreads getting ahead of themselves and going, come on, this is now too high. I'm going to sell the crap out of this. It's a physically delivered contract. So if they sell, hundreds of thousands of lots, you're talking hundreds of millions of barrels, and they can then take that into expiry. Imagine like 100 million barrels just like available at Cushing and someone's got to buy. There's not enough storage there just to be like, oh, cheers. Yeah, I'll just chuck that in the storage. Because the storage, people who own the storage are the ones selling. So it can really, really pressure the front, and you get these like aggressive move down. So that's why WTI went negative. When it did in 2020, people understand these dynamics. It's why physical delivered contracts are slightly flawed. The Murban situation as well, where no one wants Murban, will go to the physically delivered contract and sell all your Murban there, because the people who buy on a physically delivered contract have to genuinely buy the physical oil. So suddenly you're forced to hold this stuff that at a price that, oh shit, I was meant to be speculating here. Now I've got to take the oil at this level. So they know that, right? So it's a very dangerous time to be in the front month the closer you get to expiry. So if you want to speculate with time spreads, I think now you probably should be moving more towards the next month, so month 2 and versus month 3 and so on, or looking at the flyers or whatever, because it starts to get a bit dangerous with time spreads so high. Just imagine selling at 160 as a premium. That's a huge premium. There's a lot of money to be made from the oil you have in storage. Flood the market and just buy it back when no one else can. That's that's what they're going to do. It's their prerogative, right? Owning the oil infrastructure. Okay, so that's the main one. Is time spreads. Anything else quickly on that one? A more niche one? No. Okay, but generally speaking, I don't think a huge amount of money's been made. If anything, a lot of money's been lost. But anything, fuel again, there's probably a lot of people making fuel.
I was going to say, I know we don't want to say fuel every week, but it does feel like it's kind of getting that way.
Well, the market's positioned long. The market has been long all year, pretty much, after getting pretty burnt at one point in the year. So this is another surprise uplift, and it just plays right into the hands of all the length, which was more geared towards the prompt again. I think there's less length as the year goes on. If anything, there's probably some decent amount of shorts been built up, but for the prompt, it's great news for them, and it will probably elevate the time. It's the best thing that could happen. If you're more short the back end than you're long the front, you want the time spread to go massively bid, and that's exactly what's happened as well, right? So it's kind of, you got to say, people make a lot of money there. We'll probably hear by the end of the year some stories of people making hundreds of millions at these trade houses and stuff.
Oh yeah, it's going to be a real standout year for fuel. It has to be for some people.
And then all the hedge funds will start hiring.
That will do the whole cycle.
All right, let's move on now to the losers. This is the Widowmaker. So I'd say in general, a bit more of a widowmaker's market, catching a short market in crude in the back end time spreads and the overall flat price, you'd have to say generically. That's what we've heard. That's what we've seen. So a lot of people scrambling for the exit. buying back, short covering. That kind of summarizes it on the outright prices. But anything to add on that?
Yeah, just generically looking at Brent flat price and one, we saw the largest percentage move since the Russian invasion of Ukraine. 3 standard deviations away from the mean, showing that people are obviously they couldn't price it in. No one was meant to know. Yeah, a huge move. Lots
Apart from that buyer on the Monday night. Thursday night.
Yeah.
Yeah.
Okay. And then more nichely, when we were talking about looking at the East-West earlier, something that is affected a lot by the freight around the Middle East is the naphtha East-West due to the TC5 freight rate. And we saw a huge rally here. The market was positioned short. We saw short covering flows, which was people closing their short positions, which causes like the same as buying. We saw that open interest drop and net positioning, which is this bottom graph, increase a lot from being negative to about flat.
So this is the East versus West naphtha,
so this is the naphtha East-West, yeah.
So, it was 200% above the 5-year average on open interest basis.
200% of the 5-year average, so 100% higher.
100% higher. And 100, wow, it's huge.
Yeah, unbelievable.
That is a really, I mean, you would, if you had, what are the trades to do in an Iran situation? You would be like, buy naphtha because they produce so much, but probably buy naphtha East-West because it's it's happening in the East versus the West. So it's the worst contract the market could have been short on.
Yeah.
And I guess that is what it is. And how much does it rally?
So after the rally, we were looking at the average entry prices for short position players. They were on average about $3 out of the money. So they were.
That's per metric ton. That's not that big of a deal. I'm sorry, but like that in the history, if you looked at the history, the East-West was a lot lower, I think, at the beginning of the year.
Compared to the move last year with the Red Sea attacks, this isn't as significant. But
what happened on that
sort of $5 move at the high rate?
$5 is like roughly half that on a barrel basis, right? $2.50 per barrel. I mean, that's not that. I mean, it's a big move.
Yeah.
But like, you know, there's been a lot bigger moves in the past. So if anything, they've kind of gotten away with it, but I guess they've still got the position on. This is the point. So the problem with having a huge swap position like this and having so much open interest, what are you going to do about buying it back when there is literally no one to buy it back? So what they're going to have to do is take that into pricing and hope that the physical market doesn't actually get impacted that much. And it's a relative value trade. So there'll be some nuances there, right? There'll be barrels moved around. There'll be I don't think the physical has signals of it being overwhelmingly bullish, but you had a naphtha market that was generally short the cracks as well. Those are starting to rally, and I think it's rallying obviously people short covering, but in general it is a bullish event physically. So as we just said, so I think that's probably more vulnerable, I'd say, than the East versus West, because the whole of naphtha, right, if that goes bid, and ultimately the East-West is too strong, then you just make a lot of money from producing it in the UK and Europe and US. As we said, WTI Midland produces a lot of excess propane and naphtha, and you just send it over. So yeah, freight has to go up because people are going to scramble to flood it. But the higher the East-West gets, the more of an outlet that is for the West. So I think it probably does. It's not the most alarming trade. If you were short East-West, but you're long naphtha cracks and you're long naphtha time spreads, you're probably going to be generally okay. Yeah. But yeah, that's an interesting one, definitely on that one. Yeah. But what are you talking about in the millions of barrels in the open interest? How much are we talking? 15, 20 million barrels?
Dropping from 20, we'll drop around 2 million.
So you're talking about like collectively in the industry, maybe, you know,
like a few hundred KT or something.
No, but I'm saying like what, 30, 50 million lost, which sounds like an incredible amount. But if you spread it around the whole market, and if they have length in the outright naphtha contracts against it, I don't think that's going to be like massively damaging to people's years. Yeah, it's an annoyance, but I think the real open interests people and the big moves are made in the crack and the time spreads. Anyway, that's just my generic view. Okay, anything else? That was the main one. I think going back again to the time spread. So I think the very prompt WTI and Brent time spreads, there was a bullish market in the spot market, which means people generally along the front time spreads. So the trade houses and majors done well, I would say. But so many people, as I said earlier on the podcast, were long the CSO puts. So that means options on the downside of Brent time spreads and WTI time spreads in next year's contracts. And look, they're out of the money on those options, I guess, but the whole point is you hold them probably to expiry. But I think there was probably a lot of outright short positions from hedge funds in particular and trade houses in the back end. And they've had to wear a pretty serious mark-to-market loss on that. So I'd say that's probably the biggest widow maker that still exists. And I think knowing trade houses and majors, the big advantage they've got, the top 5 have, is they're like huge hedge funds, right? They can just sit on these positions and actually double, triple, quadruple down. And if it makes sense physically for it to be lower, they've got a high degree of conviction that you just wait long enough, it will compress. So, you kind of almost want people to stop out. So, you get all this fickle people who are joining in your position and kind of creating a herd, they get out of it. You kind of resell or double down.
Yeah.
You at least when it compresses to where you thought it was going to compress to eventually anyway, you're going to get even more money. So it's a horrible experience, but it is an opportunity if you have that kind of balance sheet and can wear it for that long. So that's what I'd say there. All right. So let's finish off with looking forward. This is the crystal ball. Okay, so looking at the contracts, Brent, the front time spread on Brent, gasol and gasoline cracks. Yeah, I guess you would think bullish across the board, but it's the thing with the oil market. It moves so quickly because we're doing this on a week-to-week basis. It's too late to be bullish all these things now. There's so much is priced in.
Yeah,
I'm just going to say, just to make this quick, I think you have to be bearish crude from here. The front Brent spread has had a huge rally. I would even be bearish that. I'd be bearish gasol, but I would be bullish gasoline. You've got, summer seasons, you had an outage in the US, which is what we were saying, right? When the refiners are going nuts like they are, like the biggest intake since 2019, and they're producing as much as they can, they rattle, right? And they break and there's fires. And we just had that on Sunday night. And that's the only one that could happen again. There's not been any weather scenarios yet, which could go around, could happen very soon. We've got hurricane season coming. Gasoline in particular, I would be bullish and bearish everything else.
Agreed.
Concur?
Yep.
What can we say on the technicals though? Just a quick summary.
I think it's tricky to look at technicals too much when we have had such a fundamental move, but these are just kind of the levels that I was looking at to look out for. Forget those on the screen. So immediately we've seen this gap filled from the the gap down in April. So generally when there is a gap up or down, the market does want to fill that, and you can think of that almost like a magnet. So when we do see selling, I would expect it to drop to around 70 as people do kind of fill that gap. And then once you get to 70, that's a good psychological level. We saw, at Q4 last year, we were trading up and down from 70, 73-ish. And then we can see people kind of be comfortable to trade those levels. And then to the upside, we can look at the highs from February and the high of 2025 in January, which was about 82 and a bit.
This is the thing. I heard there was talk about if we got to 80, there was going to be a lot of stop outs, because I think the longer term shorts have held out here because they're thinking, 78, 75 on Brent. Last year was reasonable, but still toppy. This year just doesn't seem, on the supply and demand balance, like people want to believe in that at all, no matter how strong the Brent time spreads are. So I think it makes sense that if anything, you're probably increasing the amount of shorts that are coming in here. It's a good time to be producer hedging, to be bullish at 75, even technical or not technical. You're going to have to have a bloody good reason. You're going to need a lot of disruption. And remember, with these events, I mean, I don't even know what the statistic would be, but it's probably going to be 9.5 times out of 10. There isn't any sustainable impact on physical. Even the Russia situation 2022, there was no actual impact on the physical, big balance, right? It just redistributed. And of course it was incredibly bullish. But you have to couple that with the fact that there was just delays to physical, not necessarily it going offline, and OPEC were in the middle of a huge cut. So again, we're in a similar situation in a way. There's a tight crude market and there's like some hype event, but the industry doesn't really believe that oil is going to be taken offline. It's something Jorge, who spoke earlier, is always going on about. Like, the one thing everyone seems to be in line with the world is that let's not disrupt the oil supply, because there's just too many countries and too many businesses, too many big, powerful players who make their money in oil. So to shut off exports is just in no one's interest. I mean, that's like you said, I think, Will said, 75% of what's going through from Iran is bought by the Chinese. what they're going to penalize the Chinese for. They're the ones who pay them. Why would they cut them off?
Yeah.
So look, generally speaking, these events are volatile and interesting, but they're huge opportunities against the backdrop of what's really going on in the world. So anything else to add? Are we in line with that? But Martha, does that mean you're the same view? Or?
Oh yeah, no, I'm not bullish. Technically, there are nothing else too interesting in the technicals. I guess looking at the Brent spread, we could see that we touched the 2025 highs when we disregarding the huge peak.
Well, that was
in normal trading. We could see that reached.
Well, going back to what I said earlier, right? So look at this. So the high of 2025, was 125, and I think probably 2024 was maybe 150 or something. So for you to get stopped out of $4, you're going to be pissed off, right?
Yeah.
I mean, I imagine there's a lot of.
That's not really something you want on your list of accolades, is it?
All right. Cool. So that's everything. I guess we'll wrap it up there. A lot we went through there. Again, any feedback, please chuck it on. Any questions, we'd love to answer them. And see you again soon. Thanks.